Let me tell you about a trap that has destroyed more retirement portfolios than almost any other mistake in investing. It is a trap that looks like safety. It looks like income. It looks like exactly what a conservative investor should want. And yet it has wiped out the savings of countless people who thought they were being prudent. I am talking about the dividend trap, the seductive allure of high-yielding stocks that promise generous income but deliver financial ruin. Over my 94 years, I have watched this trap spring shut on investors again and again. They see a stock yielding 8%, 10%, sometimes even higher. They compare it to treasury bonds, yielding 4 or 5%. They think they are getting free money. They load up on the high yielder, dreaming of the income it will generate, and then the dividend gets cut, the stock price collapses. The investor loses not just the income they were counting on, but a substantial portion of their principal as well. The trap has claimed another victim. I remember a conversation I had years ago with a widow who had inherited her husband's portfolio. He had built what he thought was a safe income portfolio, loaded with high-yielding stocks. Several paid 8% or more. She was counting on that income to fund her retirement. Within 3 years of his passing, 4 of the 5 highest-yielding stocks in the portfolio had cut their dividends. 2 of them went bankrupt entirely. The income she was counting on vanished. The principal declined by over 60%. She had to go back to work in her 70s. Her husband was not stupid. He was not reckless. He simply did not understand the difference between a high yield and a sustainable yield. He chased income without analyzing the businesses underneath. He fell into the dividend trap today. I want to warn you about 4 dividend stocks I am avoiding in 2026. These are not obscure companies. They are well-known names that appear in many dividend-focused portfolios. They pay yields that look attractive on the surface, and they are, in my view, accidents waiting to happen. I am not telling you to sell these stocks if you own them. I am not giving you investment advice. I am sharing my thinking, explaining why these particular dividend stocks concern me, and hoping you will apply similar analysis to whatever income investments you are considering. Before I reveal the 4 stocks, let me explain what makes a dividend dangerous versus sustainable. Understanding these warning signs will serve you far better than any list of stocks to avoid. The first warning sign is a payout ratio that exceeds 100%. The payout ratio measures what percentage of earnings a company pays out as dividends. If a company earns $2 per S-share and pays a $2 dividend, the payout ratio is 100%. If a company earns $2 and pays $3, the payout ratio is 150%. A payout ratio above 100% means the company is paying out more than it earns. It is funding the dividend from borrowings, asset sales, or depleting cash reserves. This is mathematically unsustainable. Eventually, the company must cut the dividend or face financial ruin. I have seen companies maintain payout ratios above 100% for years. They convince themselves that the situation is temporary. Next quarter will be better. The new product will turn things around. The economy will recover. But the mathematics are relentless. You cannot indefinitely pay out more than you earn. The second warning sign is declining revenues and earnings. A dividend can only be sustained if the underlying business generates enough cash to pay it. When revenues decline year after year, when earnings deteriorate, when the business is shrinking, the dividend becomes increasingly precarious. A company in secular decline cannot maintain its dividend forever. This is especially dangerous when the decline is structural rather than cyclical. A cyclical decline caused by recession or temporary factors will reverse. A structural decline caused by industry disruption or permanent change in consumer behavior will not reverse. Companies facing structural decline often maintain dividends long past the point of sustainability because management cannot accept what is happening to their business. The third warning sign is excessive debt. Heavily indebted companies must prioritize debt payments over dividend payments. When times get tough, when cash flow tightens, the debt holders get paid first. Shareholders, including dividend investors, are at the back of the line. High debt makes dividend cuts more likely during economic stress. Debt also limits management's options. A company with a clean balance sheet can weather a temporary downturn by reducing the dividend modestly and waiting for better times. A company with heavy debt has no such flexibility. They must service the debt regardless of business conditions. The dividend becomes the variable that absorbs all the pressure. The fourth warning sign is industry disruption. Some industries are being fundamentally transformed by technology regulation or changing consumer preferences. Companies in these industries may maintain dividends for years while their business models slowly erode. Then suddenly the erosion accelerates and the dividend becomes unsustainable. The fifth warning sign is management that prioritizes the dividend over business investment. Some companies maintain dividends even when they should be reinvesting in the business. They starve research and development, they defer maintenance. They cut corners that will eventually catch up with them. The dividend looks secure until suddenly it is not with these warning signs in mind. Let me tell you about the first dividend stock I am avoiding. Walgreens Boots Alliance. This was once a premier dividend stock. The company traces its history back over 120 years. It was a dividend aristocrat, meaning it had raised its dividend for at least 25 consecutive years. Conservative investors owned it for decades, counting on that reliable growing income. Then the dividend got cut in early 2024. Walgreens slashed its dividend by nearly 50%. Investors who had trusted the company's aristocrat status were devastated. The stock price, which had already declined substantially, fell further. The reliable income that retirees depended on was suddenly cut in half. Let me explain why this happened and why I believe more pain lies ahead. Walgreens operates retail pharmacies. This business model is under severe pressure from multiple directions. Amazon has entered the pharmacy business, offering convenient delivery and competitive pricing mail. Order pharmacies capture an increasing share of prescription volume. Pharmacy benefit managers squeeze reimbursement rates. Generic drugs, while good for consumers, reduce pharmacy margins. The retail front end of the store faces its own challenges. Consumers increasingly buy household products, beauty items, and convenience goods online or at discount retailers. Walgreens aisles of higher margin merchandise generate less traffic and lower sales than they once did. The stores that once anchored shopping centers now struggle to attract customers. The company has tried to diversify into healthcare services. They acquired VillageMD to offer primary care clinics in their stores. They invested in home health and specialty pharmacy. These initiatives require enormous capital investment and have yet to generate meaningful returns. The healthcare pivot is a bet that may or may not pay off. Meanwhile, the balance sheet has deteriorated. Debt levels increased to fund acquisitions and investments. Cash flow, squeezed by the declining core business, struggles to cover both debt service and dividends. Something had to give, and the dividend was what gave. Even after the cut, I am skeptical that the current dividend is sustainable. The payout ratio remains elevated relative to free cash flow. The core business continues declining. The healthcare investments require ongoing capital. The debt load remains substantial. Walgreens yields around 5% at current prices. That yield looks attractive compared to Treasury bonds. But I believe it reflects the market's doubt that the dividend will be maintained. If the dividend gets cut again, which I think is possible, investors will suffer further losses. The broader lesson here is that dividend aristocrat status is backward. Looking, it tells you what a company did in the past, not what it will do in the future. Walgreens raised its dividend for decades while its business was healthy. When the business deteriorated, the dividend increases stopped, and then the dividend itself was cut past. performance did not predict future results. I am avoiding Walgreens because the business faces secular decline, the balance sheet is stressed, and the dividend has already been cut once. These are the characteristics of a dividend trap, not a dividend opportunity. Let me tell you about the second dividend stock I am avoiding. Verizon Communications. Now I know this will be controversial. Verizon is one of the largest telecommunications companies in America. It pays a dividend yield over 6%. It has paid dividends for decades. Many income investors consider it a core holding. But I am concerned about Verizon, and let me explain why. The wireless business, which generates the majority of Verizon's profits, is mature and intensely competitive. There are essentially three national carriers, Verizon, AT&T, Mobile. They compete aggressively for customers, often through promotions that give away phones or offer discounted plans. This competition pressures margins and limits pricing power. The market is largely saturated. Almost every American adult already has a mobile phone. Growth can only come from taking customers from competitors or selling additional services. Neither path is easy or highly profitable. Meanwhile, Verizon carries enormous debt. They borrowed heavily to acquire spectrum licenses, build out their 5G network, and fund other investments. Total debt exceeds $150 billion. Annual interest expense consumes a significant portion of operating income. This debt load limits financial flexibility. The 5G investment thesis has not played out as bulls hoped. Verizon spent billions building 5G infrastructure, expecting it to enable new high-value services. But consumers have not been willing to pay premium prices for 5G. The speeds are nice, but they have not transformed how people use their phones. The return on 5G investment is disappointed. The wireline business, which includes home internet and landline phone service, is in secular decline. Consumers cut the cord, switching to mobile only or cable internet. Business customers migrate to cloud-based communications. Verizon's legacy wireline assets generate declining revenues and require ongoing maintenance capital. The dividend consumes approximately half of Verizon's free cash flow. This payout ratio is not immediately dangerous, but it leaves limited room for error if operating results deteriorate. If interest expense increases, if capital requirements rise, the dividend could come under pressure. The yield of over 6% reflects the market's concerns. Healthy dividend stocks rarely yield 6%. When you see a yield that high from a large cap stock, it usually signals that investors doubt the dividend sustainability or expect the stock price to decline further. I am not predicting that Verizon will cut its dividend imminently. The company has maintained it through difficult periods before, but I am concerned about the combination of industry maturity, intense competition, massive debt, and disappointing returns on recent investments. Let me share some specific numbers that illustrate my concern. Verizon's total debt exceeds $150 billion. Their annual interest expense is approximately $7 billion. That is $7 billion per year that must be paid before any dividends reach shareholders. When interest rates rose in 2022 and 2023, Verizon's borrowing costs increased on their floating rate debt and on any refinanced fixed rate debt. The dividend itself costs approximately $11 billion per year. Combined with interest expense, Verizon distributes roughly $18 billion annually before reinvesting anything in the network. This leaves limited room for the capital expenditures necessary to maintain competitiveness. Wireless networks require continuous investment. Spectrum must be acquired, towers must be built or leased, equipment must be upgraded, fiber must be deployed. A wireless company that underinvests falls behind competitors and loses customers, but a wireless company that pays out too much in dividends and interest cannot invest adequately. Verizon's management faces difficult trade-offs. They can maintain the dividend and risk underinvestment in the network. They can invest aggressively and risk the dividend, or they can try to thread the needle, doing both inadequately. None of these options is attractive for shareholders. The competitive dynamics are brutal. T-Mobile, after merging with Sprint, has become an aggressive competitor with a strong network and lower cost structure. They have been taking market share from both Verizon and AT&T. Their promotional offers are generous. Their customer satisfaction scores are high. Competing with T-Mobile while servicing heavy debt is challenging. I also worry about the cable companies. Comcast and Charter offer wireless service using a combination of their own Wi-Fi networks and wholesale agreements with the major carriers. Their wireless offerings are priced attractively and bundled with home internet and television. They are slowly taking market share at the margin. For income investors, the 6% yield is tempting, but I believe there are safer ways to generate income without taking on Verizon's risks. The potential for capital loss, if the business deteriorates further, outweighs the incremental yield compared to higher quality alternatives. Let me tell you about the third dividend stock I am avoiding, British American Tobacco. This is one of the highest yielding major stocks in the world. The dividend yield exceeds 9%. For income investors desperate for yield in a 4% treasury world, that 9% looks incredibly attractive, but I believe that yield is a warning sign, not an opportunity. British American Tobacco sells cigarettes and other tobacco products globally. The company owns brands like Lucky Strike, Pall Mall, Camel, and Newport. They have significant market positions in America, Europe, and emerging markets. The core problem is simple. Cigarette consumption is in permanent decline. In developed markets, smoking rates have fallen for decades and continue falling. Health awareness, government regulation, taxation, and social stigma all pressure cigarette volumes. Every year, fewer people smoke, and those who smoke consume fewer cigarettes. The company has tried to offset volume declines with price increases. Tobacco has historically demonstrated remarkable pricing power. Addicted consumers continue buying even as prices rise. But there are limits to this strategy. At some point, prices become so high that even addicted consumers cut back or switch to alternatives. British American Tobacco has invested heavily in reduced risk products, vaping devices, heated tobacco products, nicotine pouches. These products may indeed be the future of nicotine consumption, but they carry lower margins than traditional cigarettes. And the company faces intense competition in these categories from both traditional tobacco companies and pure-play vaping companies. The regulatory environment is increasingly hostile. Governments worldwide are implementing plain packaging, advertising bans, flavor restrictions, and other measures designed to reduce tobacco consumption. Some jurisdictions are considering generational smoking bans that would prohibit tobacco sales to anyone born after a certain year. The regulatory trajectory is unambiguously negative. Litigation risk persists. Tobacco companies have paid hundreds of billions of dollars in settlements and judgments over the decades. While the major American litigation was largely resolved years ago, new legal theories and new jurisdictions continue to generate lawsuits. A single adverse judgment could consume years of profits. The balance sheet carries substantial debt from acquisitions, including the purchase of Reynolds American. Interest expense is significant. Combined with the dividend, the company distributes more cash than it can comfortably afford. The 9% yield reflects all of these concerns. The market is telling you that this is a risky dividend. Investors are demanding that high yield because they are uncertain the dividend can be maintained. When the crowd demands a 9% yield, they are not optimistic about the company's prospects. Let me elaborate on the structural challenges facing tobacco companies because they illuminate why I am so cautious. In the United States, adult smoking rates have declined from over 40% in the 1960s to under 12% today. This is a remarkable public health achievement, but it represents an ongoing catastrophe for tobacco companies. Their addressable market shrinks every single year. The decline is accelerating among younger demographics. People under 30 smoke at much lower rates than people over 60. As older smokers age out of the population, they are not being replaced by younger smokers. The customer base is literally dying off. International markets have provided growth in the past. Developing countries had rising smoking rates as incomes increased and Western habits spread. But this trend is reversing. Governments in China, India, Indonesia, and other major markets are implementing restrictions similar to those in Western countries. The developing world is following the developed world's path away from smoking. The vaping and alternative nicotine product story is complicated. Yes, these products may represent the future of nicotine delivery. Yes, British American Tobacco has invested heavily in them. But these products face their own regulatory challenges. The FDA in America has been hostile to vaping products. Flavor bans reduce appeal. Youth vaping concerns generate negative headlines and regulatory action. Even if alternative products succeed, they may not save tobacco company earnings. Margins on vaping products are lower than margins on cigarettes. Competition is more intense because the products are newer and brand loyalty is less established. Replacing cigarette profits with vaping profits is not a one-for-one exchange. The dividend itself has become a trap for management. British American Tobacco's stock price has declined substantially over the years. If they cut the dividend, the stock price would likely fall further. Management feels trapped into maintaining a dividend they may not be able to afford long term. This is a classic symptom of a company in slow motion decline. I am avoiding British American Tobacco because tobacco is a declining industry. The regulatory environment is hostile, the debt load is concerning, and the sky yield signals market doubt about sustainability. The income looks attractive until the dividend is cut and the stock price collapses. Let me tell you about the fourth dividend stock I am avoiding, Intel Corporation. Intel was once the undisputed king of semiconductors. Their processors powered virtually every personal computer and most data center servers. The company generated enormous profits and returned billions to shareholders through dividends and buybacks. For decades, Intel was a technology blue chip that conservative investors could own with confidence. Those days are over. Intel is now fighting for survival, and the dividend is a casualty of that fight. In 2024, Intel suspended its dividend entirely. Investors who had owned the stock for income saw that income disappear completely. The stock price, already down substantially from its peaks, fell further. Intel went from dividend stalwart to dividend eliminator in a matter of quarters. Let me explain what went wrong and why I do not expect the dividend to return anytime soon. Intel missed the mobile revolution. While smartphones transformed computing, Intel's processors were absent from the winning platforms. Apple and Android devices used ARM-based chips that Intel could not or would not produce. The largest growth market in semiconductors passed Intel by. Intel missed the artificial intelligence revolution. The AI boom is being powered by graphics processors from NVIDIA and custom chips from cloud computing giants. Intel's traditional processors are useful for AI workloads, but not optimal. Once again, the largest growth opportunity in semiconductors is going to competitors. Meanwhile, Intel's manufacturing technology fell behind. For decades, Intel led the industry in manufacturing the smallest, fastest, most efficient chips. They lost that lead to Taiwan Semiconductor Manufacturing Company. Now Intel's chips are manufactured on older, less efficient technology than competitors. This disadvantage shows up in performance, power consumption, and cost. The company is attempting a turnaround under relatively new leadership. They are investing tens of billions of dollars to modernize their manufacturing facilities. They are trying to become a contract manufacturer for other chip designers. They are developing new products for emerging workloads. These efforts might succeed. Intel has formidable engineering talent and deep resources. The United States government, concerned about semiconductor supply chain security, is providing subsidies to support domestic manufacturing. There is a path to recovery, but that path does not include a dividend. The company needs every dollar of cash flow to fund its turnaround investments. Paying dividends would divert capital from essential spending. The dividend will remain suspended for years, possibly indefinitely. Let me explain the magnitude of Intel's challenge because it illustrates why dividend restoration is so distant. Building a modern semiconductor fabrication facility costs $10 to $20 billion. Intel needs multiple new facilities to compete with Taiwan Semiconductor. They are spending over $20 billion on facilities in Arizona alone. Similar investments are planned in Ohio and potentially other locations. These investments will take years to generate returns. New fabrication facilities require years to build, years more to optimize yields, and additional time to attract customers. Intel will be spending enormous sums for most of this decade before seeing meaningful benefits. Meanwhile, the existing business continues losing ground. AMD has taken substantial market share in both personal computer and server processors. Apple has replaced Intel chips in Macintosh computers with their own designs. Cloud computing giants are developing custom chips that reduce reliance on Intel processors. The revenue base that once supported generous dividends has eroded and continues eroding, rebuilding. It requires successful execution on an extraordinarily difficult turnaround plan. Even optimistic scenarios do not include dividend restoration anytime soon. Some investors might buy Intel hoping for a turnaround. That is a legitimate speculation, but it is speculation, not income investing. If you need dividend income, Intel cannot provide it. If you want capital appreciation from a turnaround, there may be better candidates. I am avoiding Intel because the dividend has been eliminated. The turnaround is uncertain, and even a successful turnaround will not restore the dividend for many years. Intel is not a dividend stock anymore. It is a turnaround speculation. Now let me step back and discuss some broader lessons from these 4 examples. The first lesson is that high yields often signal danger rather than opportunity. All 4 of these stocks offered yields significantly above the market average. Walgreens, Verizon, British American Tobacco, and Intel all traded at yields that should have raised red flags. When a stock yields substantially more than Treasury bonds, you should ask why. Usually the answer is that the market doubts the dividend sustainability. I see investors constantly chasing yield without asking this question. They sort stock screens by dividend yield and buy whatever is at the top. This is a recipe for disaster. The highest yielding stocks are often the ones most likely to cut their dividends and suffer capital losses. The second lesson is that dividend history is not destiny. Walgreens was a dividend aristocrat with over 25 consecutive years of increases. Intel had paid dividends for decades. Past dividend performance did not protect investors from cuts when the businesses deteriorated. Never assume that a long dividend history guarantees future payments. The third lesson is that industry disruption threatens dividends. Walgreens faces disruption from Amazon and changing pharmacy economics. Verizon faces maturity and commoditization in wireless. British American Tobacco faces the decline of cigarette consumption. Intel faces disruption from ARM architectures and AI accelerators. When an industry is being disrupted, even the largest players face uncertain futures. The fourth lesson is that debt amplifies dividend risk. All 4 of these companies carry substantial debt. When business deteriorates, debt payments continue while cash flow declines. The dividend is what gets cut to preserve cash for debt service. Heavily indebted companies are more likely to cut dividends during stress. The fifth lesson is that management often maintains dividends too long. Companies develop dividend histories that they are reluctant to break. Management knows that cutting the dividend will anger shareholders and damage the stock price. so they maintain dividends even when the underlying business cannot support them. They borrow money to pay dividends. They defer necessary investments. They stretch until something finally breaks. This behavior creates a pattern where dividend cuts are sudden and severe, rather than gradual and manageable. Investors do not get warnings. They get announcements that the dividend is being slashed by 50% or eliminated entirely. The damage is done before they can react. Let me also discuss what I look for in sustainable dividend stocks, because knowing what to avoid is only half the battle. I want to see a payout ratio well below 100%, ideally below 60%. This provides a cushion. If earnings decline temporarily, the company can maintain the dividend without stress. If earnings grow, the company can raise the dividend without overextending. I want to see growing revenues and earnings. A company whose business is expanding can increase its dividend over time. A company whose business is shrinking will eventually have to cut. Growth solves many problems. Decline creates them. I want to see a manageable debt load. Companies with modest debt have more flexibility to maintain dividends through difficult periods. Companies with heavy debt are one recession away from cutting. I want to see a durable competitive advantage. Companies with strong brands, network effects, switching costs, or other moats can maintain pricing power and profitability through economic cycles. Companies without moats face margin pressure that eventually threatens dividends. I want to see management that balances shareholder returns with business investment. Companies should pay dividends from excess cash flow, not from capital that should be reinvested in the business. Dividends that come at the expense of necessary investment are borrowing from the future. The companies that meet these criteria are rarely the highest yielders. They yield 3%, maybe 4%, not 8 or 9%. But their dividends are sustainable, they grow over time, they compound, and they do not suddenly disappear, devastating investors who depended on them. I would rather own a stock yielding 3% that raises its dividend by 7% annually than a stock yielding 9% that cuts its dividend in half. The math strongly favors sustainable dividend growth over unsustainable high yield. Let me close with some thoughts on how to think about dividend investing in 2026 and beyond. Interest rates have normalized. Treasury bonds yield 4 to 5% with essentially no risk. This changes the calculus for dividend investors. In the past, when treasuries yielded 1 or 2%, the reach for yield was understandable. Investors needed income that safe assets could not provide. Today, you do not need to take excessive risk for income. You can earn meaningful yield from treasury bonds, high-quality corporate bonds, and dividend stocks with sustainable payouts. The temptation to reach for high-yielding but risky stocks should be resistible. I encourage you to be skeptical of any stock yielding substantially more than treasury bonds. Ask why the yield is so high. Examine the payout ratio. Study the business trends. Assess the balance sheet. Consider the competitive position. If you cannot explain why the market is offering such a high yield, you probably should not accept it. The 4 stocks I have discussed today, Walgreens, Verizon, British American Tobacco, and Intel, all exhibit warning signs that patient analysis reveals. They are not secrets. The information is public. But investors ignore warning signs when high yields cloud their judgment. Do not let yield cloud your judgment. The purpose of dividend investing is to generate reliable income over time. Stocks that cut their dividends do not provide reliable income. They provide disappointment and capital losses. Avoid the dividend trap. Own sustainable dividend stocks from companies with growing businesses, manageable debt, and durable competitive advantages. Accept lower yields in exchange for reliability. Let time and dividend growth compound your income. This is the path to successful dividend investing. These 4 stocks are not on that path, and that is why I am avoiding them in 2026. Let me leave you with a framework for evaluating any dividend stock you might consider. First, calculate the payout ratio using both earnings and free cash flow. If either ratio exceeds 80%, proceed with extreme caution. If either exceeds 100%, the dividend is likely unsustainable. Second, examine 5 years of revenue and earnings trends. If both are declining, ask whether the decline is cyclical or structural. Cyclical declines reverse. Structural declines do not. Third, calculate the debt-to-earnings ratio if the company would need more than 4 years of earnings to repay its debt. The balance sheet is stressed. Stressed balance sheets lead to dividend cuts during recessions. Fourth, assess the competitive position. Does the company have pricing power? Can it raise prices without losing customers? Companies without pricing power face margin pressure that eventually threatens dividends. Fifth, compare the yield to Treasury bonds. If the stock yields substantially more than Treasuries, ask why. High yields usually signal elevated risk. Make sure you understand and accept that risk before investing. Sixth, research the industry trends. Is the industry growing, stable, or declining? Is technology disrupting traditional business models? Are regulations becoming more or less favorable? Industry headwinds eventually become company headwinds. Seventh, evaluate management's capital allocation. Are they investing appropriately in the business? Are they maintaining the dividend at the expense of necessary investments? Are they honest about the challenges the company faces? This framework will not guarantee success. Nothing can. But it will help you avoid the most dangerous dividend traps, the stocks that look attractive on the surface but deliver devastating losses. The 4 companies I discussed today, Walgreens, Verizon, British American Tobacco, and Intel, all fail multiple elements of this framework. That is why I am avoiding them. That is why I encourage you to be extremely cautious if you own them or are considering buying them. Dividend investing should be boring. It should be reliable. It should let you sleep at night knowing that your income will arrive quarter after quarter, year after year. The stocks I am avoiding are not boring or reliable. They are accidents waiting to happen. Find the boring stocks, own the reliable dividend payers, avoid the traps. Your future self will thank you.